Hey, good afternoon. Wanted to record a quick video here highlighting the utilization of a reverse mortgage in regards to possible long-term care costs. How do we cover those costs? Obviously, as we get older, the cost of long-term care coverage is pretty expensive. And obviously, if you don't have insurance to cover that, you've got to pay for those costs out of pocket. And one of the nice features about the reverse mortgage is the ability to utilize a line of credit feature that's part of the reverse mortgage as a buffer asset for needs down the road. So we can think of that buffer asset. We can actually utilize it to offset sequence of return risk if we're pulling assets out of a retirement account. Let's say like we need those funds on a monthly basis to provide additional income. We can use that reverse mortgage as a buffer asset to offset the risk during down market years. Another way that the reverse can be utilized is for a buffer asset to prepare for long-term costs. So the sheet that's on the video right now, these are actually clients of mine that I closed on about 2 years ago. At that time, they were in their early 70s, or at least the youngest borrower was in their 70s. They were only about maybe 6 months apart, so they were both pretty close to that. They had a house that they owned free and clear, and they also they had other retirement accounts and so forth. But their big concern was, hey, what happens if we have a long-term care need down the road? So their financial advisor had reached out to me and asked me to follow up with them. And what we did is we took a look at, hey, what does this mean if they were to originate a reverse mortgage today? And more importantly, what does this mean in the future? So one of the features that's really a nice feature about the reverse mortgage line of credit is that line of credit actually grows over time. I can get into the details with somebody if we want to sit down and have a conversation about it. But the bottom line is HUD allows that line of credit to grow. It basically grows at the same factor that HUD uses for what's called principal limit. And so you take the interest rate along with 0.5% mortgage insurance premium, divide that number by 12, and that gives you your growth factor as a percentage on that line of credit monthly. Keep in mind, these particular loans utilize an adjustable rate feature, so that line of credit can actually grow at a higher clip. And as I'm recording this video, those particular rates are higher right now. So the line of credit that I'm talking about in my illustration here is actually growing at a higher clip than what is reported on this estimation right here. One of the things to keep in mind about that line of credit is that is unrealized equity. And what that means is the borrower hasn't pulled any of that money out. So there is no loan balance growth based on that line of credit because you haven't taken the cash out of that loan yet. There is no accruing interest based on that. So the only growth on this particular loan at the time of close was the closing cost and how it grows over time. Matter of fact, with these particular clients, about a year or two after we closed on this loan, they actually paid that loan balance, that initial loan balance, down to about $1,000. You actually have to keep some money in the loan balance in order to keep this loan open. And so they wanted to make sure that, assuming they don't need any funds from this reverse down the road, they wanted to make sure that their heir, which was their only child, was going to be able to pay off the loan balance fairly easily. So if you take a look at this scenario right here, I've highlighted that line that says remaining line of credit. And you can see that at the close of escrow on this loan, they had an initial line of credit balance of about $266,000. with that growth factor, which was roughly projected at 3.7%. So add that 0.5%. Think of this growth factor at about 4.2% annual. You can see how that line of credit balance grows over time. Assuming they're not going to need any long-term care needs until they're probably in their 80s, let's start with age 80. That loan balance that was line of credit balance that was 266,000 or just under 267,000 at close of escrow is now over 400,000. And with the increase in rates over this past 12 months, that projected line of credit balance is going to be even higher. Now, keep in mind that if rates come down in the future, the growth factor on this line of credit is going to slow down somewhat. But the bottom line is, even at a pretty low growth rate of about 4%, projecting back to when they closed on this loan, that line of credit is going to be in the 400,000s, and that should give them a significant amount of money that they can draw from to pay for any long-term care costs that may be there for one or the other. Statistically speaking, I think the projected is homeowners or senior citizens age 65 and older. There's a 50% likelihood that one of you is going to need long-term care cost at some point. Obviously, that doesn't happen to everybody, but on average, that's going to happen to, if you're a two-person household, there's a statistical probability that one of you is going to need some long-term care at some point. So this is a great way to prepare for that. The key to this is doing this early. So a lot of people who have paid off homes going into retirement, age 62, 63, 64, 65, I've had conversations with me that they will say, hey, I don't need a reverse mortgage. I have plenty of assets and I have a paid off house. Well, that's one of the reasons why they need to originate a reverse mortgage early. They want to leverage time in order to see this line of credit grow. Now, if they don't need the line of credit down the road, that's great. No harm, no foul. They haven't had a huge impact on the equity of the asset over time, which means that any legacy, i.e., assets that go to family for inheritance, will still be preserved, but they've done their proper due diligence up front in order to prepare for what potentially might happen in the future, which is long-term care costs. So yeah, when you look at a reverse mortgage, it's not just about eliminating monthly mortgage payment. It's not just about a loan of last resort for someone that's in their 80s and 90s and they're scrambling to make ends meet. And so we tap into the equity. It's also a great tool for preparing for other needs, as I mentioned, for either sequence of return risk when you're pulling assets from your retirement accounts, or in this case, preparing for possible long-term care needs. So if you have any questions, want to talk a little further about how a reverse mortgage might benefit you as you head into your retirement years, or maybe you're in your retirement years already, reach out to me. My name is Dennis Graves. I'm with HECM Mortgage. I look forward to having a conversation with you. God bless.